This is the homework from Chapter 10, Preparing a Flex Budget. So we're working on budgeting in Chapter 10. Gator Drivers, this is exercise 10.1. Gator Drivers is a company that provides diving services such as underwater ship repairs to clients in Tampa Bay area. The company's planning budget for March appears below. During March, the company's actual activity was 190 diving hours. Prepare a flex budget for the level of activity. So this information was given on their budgeted diving hours. They budgeted 200. This is the per unit cost, and then there's fixed costs. So revenue is $380 per unit. Wages and salaries is $130 plus fixed cost. Supplies is $5 plus no fixed cost. Equipment rental is $26 per unit plus $2,500. Insurance is all fixed at $4,200. And miscellaneous is $1.50 variable and $5.40 fixed. So planned budget is $51,740 in expenses for a net operating income of $24,260. Now we must prepare our flex budget for Gator Divers. A flex budget is a budget that takes into account the fact that actual per unit is different than budgeted units. So this is what is called an activity variance. And this is for month ending March 31st. Okay. So while I'm talking you through this, we're going to make it look nice and pretty. Okay. So actual diving hours is 190. So this was given in the problem. Revenue. We're going to take the actual hours $190 times the variable revenue. And then we would add fixed if there was fixed. Expenses. They had wages and salaries. Actually, I'm going to save myself typing and just copy this because it's going to be exactly the same. So, wages and salaries. So it's telling me I made the wrong formula here. I need to put the parentheses to start with. And I'm going to multiply that by the 190, and in a flex budget, the fixed will remain the same as budgeted. And then I'm just going to go ahead and drag this down all the way. Oh, actually, I forgot to do something. That's why the number comes out crazy. I forgot to fix it to the 190. Now, I can go ahead and drag my formula down. And my total expenses will be the sum of all of this. And so my net operating income now for my flex budget is $22,085. So this flex budget represents the fact that there were actually 10 less diving hours than budgeted, which was 200. And this is a flex budget. We're going to move on to exercise 10-2. This is where the company is showing activity variances. Air Meals is a company that prepares in-flight meals for airlines in its kitchens located next to the airport. The company's planning budget for December appears below. In December, 21,000 meals were actually served. The company's flex budget for this level of activity is shown below. Required: prepare a report showing activity variances for December. So this information was given in the book. The budget. This is their planning budget. This is their flex budget. So in order to prepare an activity variance, I'm going to copy the title, move it right down here, and I'm going to call this activity variance, and I'm going to copy from the very top exactly what we're comparing, and then I'm going to actually insert one more row here. I'm going to have planning budget, flex budget, variance. Okay, so I'm going to literally copy everything and paste. Actually, it says that because I pasted formulas here. I just wanted to paste numbers, and we will make this here. Now my flex budget totals were right here. Just going to copy. I'm going to paste the numbers here. So at this point, all I've done is copy and paste. I'm going to add the lines so that we know where we're at. Okay, variance. You're going to take planning minus flex here. So, actually, I'm sorry, flex minus planning. And this is a favorable variance of 1,000 units, right? So that's our activity variance. So on the revenue, we take flex minus, and we had a favorable variance. To figure out if it's unfavorable, we can make a negative. And on expenses, we will take planning budget minus flex budget. If we come up with a negative number, it's unfavorable. If we come up with a positive number, it's favorable. So this would be an unfavorable variance. Unfavorable. So we put a U. U. This was the same. I can't type U apparently. And U. So now we're going to add up this plus this. So we had a positive revenue variance and a negative expense variance because we actually had 1,000 more units than we thought. Now, given the fact that some of this cost is variable, that would make sense. But overall, we had a favorable variance of 1,100. And this is an activity variance report. We're going to continue on to exercise 2-3. This is showing both a revenue and spending variance. Olympic Farms sells oysters in the Pacific Northwest. The company has harvested and sold 7,000 pounds of oyster in July. The company's flex budget appears below. So here's their flex budget, and then we have actual. So instead of comparing planning and flex, we're going to compare actual and flex. So take this out. And we are going to call this revenue and spending variance. Okay, so we are going to copy the setup here. And then up here we're going to have flex, budget, actual, and variance. Okay. I'm going to literally copy this. Remember what we did last time, we pasted numbers. We could go back and fix these and make them formulas. Or actual. Right here. Okay, so actual minus flex budget. There is no activity variance, right? So actual minus flex. Actual minus flex. So that's a negative variance, so it's unfavorable on the revenue. And then we do flex minus actual. If it's negative, it's an unfavorable variance. So this is an unfavorable, but this is a favorable. Negative number, unfavorable, favorable, favorable, unfavorable. Now we're just going to add these up. And then we are going to take our revenue variance, add together our expense variance. So this is a total unfavorable. So we have an unfavorable spending and revenue variance total of $1,400. This is a variance for revenue and spending. We're going to move on to exercise 10-4. This is preparing a flex budget performance report. Mount Hood Air offers scenic overflights of Mount Hood and the Columbia Ridge Gorge. Data concerning the company's operations in August appear below. The company measures its activity in terms of flights. Customers can buy individual tickets for overflights or hire an entire plane for the overflight at a discounted rate. Required. Prepare a flex budget for the report for August. Okay. What are the variances and should management be concerned? Alright, so this is the information they gave us. They gave us a planning budget, they gave us a flex budget, and they gave us actual. So here we go. Mount Hood. And this is going to be a flex budget performance report. Okay. So we're going to have the information here. And then we're going to have our planning budget. And then we're going to have our flex budget. Just copying. There's no formulas in this because this was basically like typed up from the book. And then we're going to create a variance column. Then we're going to add our actual. And create another variance column. Alright, so in order to calculate the difference, which is variance activity, this is based on the fact that flex is different than planning. We're going to take our flex and minus the planning for the revenue and the number of flights. And then we're going to take our planning versus flex. If it's a negative number, it's unfavorable. And we will add this up. Of course, we had more flights than we planned. And we'll take our positive spending here because of activity. So I'm actually going to insert another little column. We're going to make it really small. And this is a favorable variance. This is an unfavorable. Any negative number down here on the spending is unfavorable. Unfavorable. but we have a favorable activity variance, of course, because we had 2 more flights. Now let's see if we had a variance, what our variance was for revenue and spending. I'm just going to make this look pretty. Okay. So, we're going to take our flex and subtract, we're going to take our actual and subtract flex up here. And then we're going to take flex on the spending and subtract actual. Anything negative I'm going to make this look nice. So we had a positive activity variance, but a negative spending and revenue variance on this situation. In the next chapter, we'll get to what that really means in chapter 11. And this is a flex budget performance report. We're going to keep going and finish the final problem from this chapter. You've just been hired by Secure Door Corporation. This is exercise problem 1020. The manufacturer of a revolutionary new garage door opener. The president has asked that you review the company's costing system and, quote, do what you can to help us get better control of our manufacturing overhead costs. You find that the company has never used a flex budget, and you suggest preparing such a budget would be an excellent first step in planning overhead and overhead planning and control. After much effort and analysis, you determine the following cost formulas and gather the actual information for April. During April, the company worked 18,000 machine hours and produced 12,000 units. The company had originally planned 20,000 machine hours. Prepare a report showing activity variances for April. Prepare a report showing spending variances for April. What does this all mean? Okay. So here was the information given in the problem. First thing we need to do is prepare a flex budget. So what we're going to do is we have Securidor Corporation. This is activity variances for month ending April. Alright. In order to calculate the activity variance, I'm going to do this. And we're going to start with machine hours. That's how we're being measured. And then this one is our planning budget. And this is our flex budget. And this is our activity variance. Okay. So now that we've done this, we first need to calculate our planning budget. Our planning budget was based on 20,000 machine hours. So, utilities would be 20,000, and I'm hitting F4, so, times whatever the variable amount is, but I'm going to go back into my formula and put parentheses around here. And then I'm going to add my fixed amount. Now that I made this formula, I should be able to drag down and come up with the right number of expenses. The only way this formula will work correctly is if you put the F4 around, if you put F4 for the number of machine hours. Now in our flex budget, we actually had 18,000 machine hours. So now our utilities are, we open the parentheses, select the number of machine hours, hit F4. We multiply this by the variable column. We close our parentheses and we add our fixed expenses. Again, I should now be able to drag this formula down. If you come up with funky numbers that don't make sense, you probably forgot to hit F4. F4 makes the constant, so it keeps going back to this $18,000 and multiplying. To get the total expenses, we add this together. Now, we want to figure out our activity variance. On expense side, it's planning minus flex. And if it's positive, it's a favorable variance. And we can basically just drag this down. Favorable, favorable, favorable. This is break even. Well, we had favorable spending variance because based on activity because we produce less, correct? So the activity variances are all favorable because there was less than the planned activity. Therefore, variable cost should be lower than the original budget. Now we need to go on and prepare a spending variance. I'm just going to copy this, make setup easier. And this is spending variance instead, if I could spell. Variance. Okay. On this one, I'm now going to take my flex budget, actual, and this will be spending variance. I'm going to copy these items so I can save myself from typing. Now on my flex budget, my machine hours will stay the same, and they will be the same for the actual. I'm literally going to copy this number. Copy, and I'm going to paste numbers. Format them, make them look all pretty. Okay, now the actual was actually given. I'm literally going to go down here and paste numbers. I'm going to add these up. And now all I have to do is calculate the variance. And for it's flex minus actual. If it's negative, it's an unfavorable variance. So this is unfavorable. This is a favorable, and the rest are unfavorable. Add this up. And we have an unfavorable spending variance of $5,300. And what this really means is that although activity is less than we planned, it actually costs more. So an unfavorable spending variance means that the actual cost was greater than the cost that it should have been for the activity. A favorable spending variance means that the actual cost was less than it was for that activity. While this makes some intuitive sense, sometimes a favorable variance may not be good. For example, the rather large favorable variance in maintenance might mean that you've been skimping on maintenance. Since these variances are all fairly large, they should all probably be investigated. Oh, that's my calendar. So, here's what we have. We have all of this, and we had less activity, so we had a positive activity variance because we had less activity. But spending on all of these items are pretty large variances. So we should really look into why is it costing more and why did we save so much on maintenance? Did we skip maintaining certain things? So this is going to require some more investigation by management. And this is it for chapter 10 on flex budgets and spending and activity variances.